Good afternoon, everyone. Thank you for joining us today. I'm accompanied with my colleague Adam Jury and myself, Jarred Sullivan. We are both global multi-asset strategists for the group. And today we would like to share with you a bit of insight into the global economy, how we are positioned in terms of the current turbulent environment, and a little bit of insight in terms of the future dynamics. So I'm quickly going to share my screen and get started. Please feel free to ask any questions in the chat, and we will address them either at the end, or my colleague Adam is happy to address them during the course of the presentation as well. So without further ado, I think it is very important to start off with a global assumption set. So some of Ashburton's key global assumptions heading forward into a future state are that from an economic point of view, we still expect the global economy to remain above trend, although we expect growth to slow on a rate of change basis compared to the growth rates that we saw last year. From an inflation perspective, this has been awfully topical of late, and we expect the theme to remain as it is, at least in the short term, for it to be particularly sticky, and that is because of the elevated owner's equivalent rent, i.e. housing prices, as well as the rental prices that we have seen of late that have filtered through to inflation. But we do think that we are nearing a peak, and that we would and indeed expect inflation to slow starting in the second quarter of this year, and more meaningfully as we head into the second half of this year. Liquidity is a major theme, and we expect it to continue to be drained from financial markets, particularly in the coming months, given obviously recent hawkish rhetoric, especially from the US Federal Reserve. And no doubt that we expect volatility to increase in the year ahead, certainly a lot higher than what we saw last year. So without further ado, to get into the interesting dynamics of what is happening on the global economic front. So I think a great place to start with is COVID cases. And thankfully, what we've seen more recently is that the recent Omicron variant has certainly had a significant impact in terms of case counts. And we have thankfully seen them roll over quite significantly so. And I think what was a particularly well-desired outcome is that it did not translate into very high death rates. And we also see that being quite contained around the globe. So this is a pretty ubiquitous theme where we are starting to see COVID cases come down and early signs of normalization coming to fruition.
Jarred, sorry to jump in there. Your slides, we've just noticed, aren't sharing quite right. We can see the notes there. I don't know if you can put it into presentation mode again.
Of course.
There we go. Perfect. Thank you.
No problem. So can you see the slide, Adam?
Yeah, perfect now. Thank you.
Okay, so to take a look at the high frequency data that we have seen of late, it is still very, very strong. So one of the indices that we like to look at is a purchasing managers index, where this is a diffusion index where any reading above 50 indicates economic expansion and any reading below 50 indicates economic contraction. So while the readings are still elevated both in the manufacturing and services spaces, coming in at 57.6 and 59.9 respectively for manufacturing and services, we are starting to see economic activity come significantly off its peak. So it is slowing. I think what is particularly important in these surveys is the underlying details. And one thing that we found very encouraging is that the supply delivery subcomponent is now coming off its peak as well, so particularly in the manufacturing sector, where a lower number would mean that supply delivery times are now shortening. So that is very nascent evidence that we're seeing that the supply chain bottlenecks that we have seen around the world start to ease. And that is a key theme that we expect to persist throughout this year as we return back to normalization, particularly from a trade perspective. So we think that's particularly encouraging. And another encouraging aspect is that in the prices paid subcomponent, particularly in the manufacturing sector, we are starting to see those readings ease somewhat, which should translate into a much more tempered inflation backdrop as we progress into the course of the year. So taking a look at the consumer health from an income statement and balance sheet perspective. So in the top left-hand graph, we can see US real disposable income. So that's income adjusted for levels of inflation. And we can see that income is now back towards trend levels. So there's not much in terms of autonomous income that has been received, particularly from stimulus checks, and is much more normalized compared to what we have seen in recent times. And in fact, the orange line shows that if you actually strip these transfer payments out, the US income statement would be a lot weaker. And a very interesting fact that we've seen of late is that savings rates, so precautionary savings, have unwound. And you can see that evidence if you look at the savings to disposable income ratio being back to more normalized levels, roughly around 2017 levels. So it really does speak to the theme that excess savings has certainly been diminished in that regard. But what is encouraging from a balance sheet perspective is that household debt as a proportion of GDP and the debt servicing costs are still quite low. So consumers do have the ability to relieve themselves, which is exactly what they have been doing of late. So to speak to the next slide in this dynamic, you can actually see that credit cards the use of credit cards in the US, which is weekly data that we track, is starting to increase. So that really is a theme of now consumers relevering themselves going forward. And that is something to, I think, be particularly concerned about in terms of the fact that, it is now not being used from excess savings levels, but it's rather being used through a credit card channel into a slowing economic growth environment where the catalyst that we had last year in terms of autonomous income from stimulus checks, as well as extraordinary easy monetary policy, are now both dissipating. So that is an interesting phenomenon, combined with the fact that very high levels of inflation are eroding real incomes. So if you take a look at the right-hand side, real average hourly earnings are actually still deeply negative. So that is a theme that we have seen, that inflation really has weighed on the real income prospects of the US consumer. So in terms of the other high frequency data that we have seen of late, so taking a look at the City Economic Surprise Index on the left-hand side, any reading above 0 indicates above expectations and any reading below 0 indicates below expectations. Over the last couple of months, we've seen a downswing in a lot of the high frequency data in terms of, the previously upbeat expectations that market participants did initially have. So one of the more frequent, I think, upbeat data releases that we've seen of late was January retail sales, but that was certainly thrusted up in an upward fashion due to high inflation levels. I don't think it is likely that we're going to see sustained strong retail sales prints like we did last year, and I do think that we're going to see it slow on a rate of change basis because of the fact that excess savings are diminished and a lot of the catalysts that we had last year are now dissipating. And you can now start to see that reflected in growth prospects. So this, just to give a bit of color to this is growth projections for the first quarter of 2022. So on a quarter-on-quarter seasonally adjusted annualized rate basis. And you can see that since December 2020 and all the way into more recently, economic projections have been significantly downwardly revised, at least in the short term. And arguably risks are tilted to the downside, especially if we have tighter monetary policy come to fruition this year, which could potentially cut off long-term growth prospects. So to actually dive into a little bit more detail from an economic growth perspective, what we have seen is that the fourth quarter GDP print in the US was primarily made up of change in private inventories. So almost 2/3 of that growth came from the change in private inventories subcomponent. And if you take a look at even more monthly data, you can see that US retail inventories have significantly increased. So we think this is a very interesting phenomenon, that if you do have a bit of a slowdown in the consumption expenditure side of the equation, even in the face of potentially higher wages, if they are not able to meet the demand that is currently has been present for most of last year, you could be left with a potential surplus of inventory, which could help slow the inflation backdrop, particularly as we head into the second half of the year. So we think that this is very interesting in terms of inventory build now taking place, and if that is not met by the same level of demand that we saw last year, it could potentially be disinflationary as we progress throughout the year. And that is also something that we've seen in the PMI series, where the backlogs of orders are now starting to come off their peak. So a lot of that pent-up demand is already being fulfilled. So if we just take a step back and have a look at what happened in 2020 and 2021. So 2020 was the year of lockdowns and really met with extraordinary monetary and fiscal policy stimulus, really unprecedented, and the use of the word unprecedented was also unprecedented. So in 2020, what we saw was quite a significant change in the PE multiple. So the price that you would pay for your earnings per share significantly increased towards the second half of the year in 2020 because of very, very low real cost of borrowing. So that really contributed significantly to total returns as opposed to just earnings. Now, if we take a look at what happened in 2021, it was the year of a V-shaped recovery in earnings. So we saw significant and sharp rebound and some extraordinary high growth rates that really supported a lot of these fantastic company releases that we have seen in recent quarters. But now, heading into 2022, what has been a theme is we have started to see a bit of a derating. So because of higher real yields and the higher real cost of borrowing, because of more hawkish monetary policy expectations now being priced in. And to keep up that same level of earnings, we would need an extremely strong consumer. But as we mentioned earlier, a lot of these catalysts that we have seen of late have started to fade. So it does really bring the sustainability of earnings into questions, as well as very difficult base effects to compare a lot of these company earnings with. So we'll speak about that in a bit more detail when we get to some of the earnings slides and market performance. Now, to take a look at an investing style perspective over the last year or so, we saw very good performance from a growth and value style bias up until the end of 2021. However, more recently, we've seen quite a bit of a sharp downturn, particularly in the growth investing style bias, very high multiple based stocks, and that is because we have seen a very real lift in the cost of borrowing, but in terms of communication from the Fed for future state to really lift interest rates, and the potential draining of liquidity can significantly hurt a growth investing style bias. So that is exactly what we have seen of late. And what's also quite interesting is the big divergence that we start to see from the S&P 500 and small caps. So we've seen small caps come under an enormous amount of pressure lately relative to the S&P, and that is normally what is the case where you have tighter monetary policy and a potentially slowing economic backdrop. What is very interesting to see on the bottom left-hand side is if you take a look at the high beta to low beta investing style, the gap between the two has narrowed. However, high beta has been held up significantly so from a lot of your energy companies that do have quite tight supply and inventories that are very much supporting, the extraordinary free cash flow yields that we have seen in the energy sector. So that is one of the reasons that we are seeing that hold ups at this juncture, because I'm on the supply side of this equation. But I think from a risk reward perspective, I think this is definitely the year to be nimble, as well as be very defensively positioned in terms of trying to generate positive levels of return. And I think that's really evidenced by taking a look at the momentum type investing style versus your defensive type investing style, where I think from a risk reward perspective, it certainly would have paid off to be a bit more defensive. Now, to take a look at the longer term dynamics and what the impact on yields will be in a future state. So the last 2 decades have been met with a decline in the labour force participation rate. So willing and able participants of the ages between 15 and 64 that are able to participate into the labour force. That has significantly come down, and one of the major reasons for that is because we've seen a widening in population pyramids where you have a more elderly skewed demographic, where people are living longer, have higher life expectancies because of better healthcare systems, and that has been obviously a very encouraging development, but that has long-term implications for growth. So it's no coincidence that you see a very good correlation between the velocity of money as well as the labour force participation rate. And one of the consequences of having a much lower labour force participation rate is you have lower potential growth in a future state. And that is because you have less labour actively participating in the labour market, and that means that your velocity of money will exchange hands, so the amount of money that is exchanged hands between individuals in the economy is a lot lower. So that multiplier effect has certainly been diminished, and that is something that we think could bring about potential lower growth rates in a future state in the absence of any significant supply side reform from an immigration perspective. So this is a very dominant theme in the developed market space, which I think is really going to keep interest rates lower for longer. So even though we've seen quite a significant rebound in a short space of time in terms of the US 10-year rate, on a long time series, I think if you don't have the potential growth to match up to really getting high levels of growth rates from a labor force participation rate perspective, it is likely that you will see low interest rates for longer. So even a US 10-year rate at about 2% is historically still quite low. And I don't think that the US economy, or many developed economies, in fact, can actually handle significantly higher rates from here. One, because we have quite a lot of companies, I think close to 1 in every 5, at least listed on the S&P, have interest expense exceed their corporate cash flow. So that's a very interesting phenomenon as well. And two, the debt servicing ability of the fiscus, particularly in the US, is something also to consider in terms of the recent trend change from a yield perspective. So those are very interesting dynamics that I think over the long term will really show that we will likely be in a case where interest rates are likely to stay historically low for longer. And what is encouraging is one of the models that we like to run is taking the data that I showed earlier from the manufacturing and services sector, the prices paid subcomponent, and really combining the two, which is a very good 3-month leading indicator for where inflation is likely to go. And the main reason for that is it takes time for a lot of the price changes that are experienced in the manufacturing and services side of the economy to really filter through to inflation dynamics. So that is one of the early signs that we have seen of reprieve on the inflation front. And we are expecting that we are likely near a peak on inflation, and that is encouraging in terms of, really getting to a lot lower and more sustainable levels of inflation in a future state. And rightly so, in the near term at least, our theme is that it does remain sticky, and a lot of forecasters around the globe have definitely reflected that in terms of the most recent polling of economic projections in the February survey that we have seen for US inflation from here. But I think the theme still remains that inflation does slow as the couple of quarters progress, particularly in the fact that we have quite a significantly hawkish monetary policy environment to react to high levels of inflation and potentially lower levels of demand from what we had last year. So I think this really does point towards a slower inflation backdrop on a rate of change basis. But short-term sticky, and as we head into the second half of the year, I think we're likely to see much more contained inflationary pressures. And just to speak about the housing component within inflation, so that is about 33% of the weight in the basket. And in fact, if you look at the most recent housing prices from a median perspective for existing and new home sales, they are significantly off their peaks. And again, that takes time to filter through to the inflation, official inflation statistics, and that is only likely to potentially filter the peak in the shelter price component from potentially about March to May, of which significant base effects for the second half of the year is likely to lead to a slower inflation backdrop where monetary policy isn't likely needed to be as hawkish to slow the inflation backdrop at this juncture. What is very interesting is what is happening on the natural gas stage. So if you take a look at the differences in natural gas prices in the United States, Europe, and the United Kingdom, you would see that all three of them, albeit to varying degrees, have had significantly higher US natural gas prices. And particularly in the case of UK and Europe, where it's increased roughly between 300 and 400% respectively since December 2020. Now, given the fact that Europe does rely on, or has very tight inventories rather, on a natural gas front, having exports of natural gas from Russia would certainly help, I think, bring down a lot of the price pressures. But what we've seen at least on the geopolitical stage is that there hasn't been anything in terms of exports if you look at the daily data. So just to point your attention to the right-hand side, you'll see that natural gas flows via the Yamal Europe pipeline have actually been zero on a day-on-day basis. So that is obviously due to heightened geopolitical tensions that we have seen between Russia and Ukraine and the sort of outside involvement, and that is likely going to be a tail risk that we need to obviously watch quite closely, but nothing destabilizing from a base case perspective. So if we did have to have a destabilizing scenario, we think a lot of the safe haven precious metals would definitely serve you well, and would even serve you well as a potential growth hedge to downside surprises to growth. And that is actually something that we hold in the multi-asset fund range as a diversification element to our multi-asset fund range. Now to speak about the monetary and fiscal policy response. So just to take a look at actually what the Fed minutes was saying last night, which is a lot of the information is already known, but it's always good to have it particularly explicit in terms of, in a black and white writing from the Federal Reserve. And at the time of the minute compilation, participants were speaking about a roughly 70% probability of hiking the federal funds rate at March. Now, if we look at the futures curve, that's all but a certainty priced in. I think the bigger question is it going to be 25 basis points or is it going to be 50 basis points? So if you look today, there's about a 33% chance that there could be a 50 basis point increase at the March meeting, especially because of the commentary coming out from different Federal Reserve members about needing to really stem the inflation backdrop and be more reactionary in terms of future monetary policy actions. So that is going to be the key phenomenon that we're going to have to be watching closely. But the path of interest rates from here, as mentioned in the minutes, is certainly higher in terms of needing to get to a more normalized rate path. Now, what was very interesting is on the balance sheet front. So given the fact that quantitative easing is coming to an end in the end of March, the question comes from, is this going to be a passive balance sheet runoff or is this going to be an active balance sheet runoff? So there's a big difference between the two, when active balance sheet runoff would involve selling securities into the market, whereas a passive one would be allowing securities, particularly mortgage-backed or treasury securities, to mature at their own pace. So if it's a passive runoff, roughly $2 trillion worth of securities mature in the next 2 years alone. So if they decide to be active, it could be a lot more than that. So the pace of balance sheet reduction could be quite significant. But I think the Fed, again, what they've reiterated in these minutes, is that they would prefer to rather keep the level of treasury security holdings a bit more stable relative to the level of mortgage-backed security holdings. So if we did have to see a balance sheet reduction, it is likely to come more from the mortgage-backed security side of things, as opposed to your traditional treasury securities. They have said that the timing and pace of balance sheet reduction is still a bit uncertain, and it's very much dependent on their mandate of full employment and inflation stability. But they have offered some clues in the way of the pace of such in the recent minutes. So they did explicitly say that they expect it to be faster than what they did in the 2017 to 2019 period, and the timing of such is likely to start in the third quarter of this year. So I think these are things that the market is fairly comfortable with and already knows at this juncture. The actual magnitude of such is very much in question, however. So if we actually take a look at what federal funds futures markets are pricing today, there's 6 25 basis point incremental rate hikes priced for this year. So that is quite an aggressive monetary policy response to really stem inflationary pressures. So that is currently what is being priced today. So if we actually rewind to 3 to 5 months ago, this wasn't even something that I think many market participants would even consider in terms of, monetary policy response from the Fed, that they needed to keep, monetary policy relatively loose to support the broader markets, high yield credit, and, really to suppress a lot of the risks in market. However, what we also see on the liquidity stage is that it is actually being drained from the fiscal side of things as well. So on the left-hand side, this is the Treasury cash account. So this account is where all the sale of debt from the US Treasury goes on a month-to-month basis, as well as tax revenues, etc. So what we have seen of late is that there has been a replenishing of this account. So this is actually sucking liquidity directly from the private sector. So it's not as stimulatory as what it was in the late 2020, early 2021 period, where a lot of the liquidity was being provided to the market. Now the exact opposite is happening. So from a fiscal perspective, and that will likely continue to be the case to rebuild that account and not be as supportive to broader markets by providing liquidity. And if we take a look at the right-hand side and just painting a picture of really what the future state of the balance sheet is likely to look like, as I mentioned earlier, quantitative easing is coming to an end at the end of March. But the real question is how steep that red line, that red arrow is going to be. How quickly are they really going to taper off on the balance sheet going forward from here? So that is really the $1 million question. Where are they going to do this at an exorbitantly swift pace? How they're going to do this? Where's it going to come from? And that is something that is still unknown to the market at itself, and I even think the Federal Reserve themselves. So it really matters when you tighten. So just to take a look back in time. So if we remember when Janet Yellen was Fed chair, and back in 2013, 2014, we saw very hawkish rhetoric in terms of, rate hikes being talked up and priced into markets to say, we really need to tighten policy and, really get inflationary pressures under control at the time. That was something that, the markets seemed to price in quite meaningfully so. So what you saw was quite a significant lift in the 30-year yield, which is very sensitive to long-term growth expectations as well as monetary policy, long-term sustainable monetary policy rather. However, the economic reality of it is if you do hike into a slowdown where the economy can't take it and you really cut off long-term growth and inflation prospects, you could end up in a scenario where you could collapse the yield curve, because it could be exactly that, tightening into a slowdown where it's too fast for what the market can handle, and you can get the exact opposite effect of what would usually happen to the yield curve. So that is something we're paying very close attention to say, is the economy strong enough to really have yields significantly increase again from here? Or is it a policy error that they're going to tighten too much, and it could be tightening into a slowdown, which could have disastrous effects in terms of broader equity markets. So if we fast forward to what actually happened in 2015, they hiked once, and we saw the yield curve collapse, and they ended up pausing. They paused for about a year before they could resume their hiking cycle. So this is why I speak about timing, because when they decided to hike again, this is when Trump was inaugurated under his presidency, and they really hiked into an economic upswing, which is what monetary policy is supposed to be, pro-actionary in terms of, hiking into future growth and inflation dynamics. And this is exactly what we saw. We saw very strong growth prospects under this era, and policy could be normalized under this scenario. But then fast forward to 2018, when you hike too many times again into a slowdown, the yield curve collapsed again. So these are interesting dynamics, and I think something that we can learn from history in terms of monetary policy reactions into the type of economic operating in. So if the Fed do tighten too many times into a slowdown, we are looking out for the potential that we could see a similar scenario on that front. Or if they have a much more measured response, then I think they could obviously prevent a collapse in yields. So that is a very interesting insight in terms of learning from history. Now to go on to, I think, another interesting dynamic in terms of China. So last year, unfortunately, China had a very terrible time in terms of haphazard policy pronouncements, economic growth, the downturn in credit impulse. So it did have an unfortunate year in terms of a lot of the sustainable growth prospects being priced in, as well as company earnings. So what we've seen of late is data has come off its lows, as you see in the manufacturing PMI, but it's still relatively slow. But one thing, if you look at the PMI data on the left-hand side, but it is above 50, so it indicates that it is now still expanding of late. But more importantly is if you actually look at the underlying subcomponents in these sort of series, you see that the difference between input prices and output prices, both on the manufacturing and service side of the economy, have narrowed. So what that is showing us is that there's less margin squeeze taking place from an economy-wide perspective, which is very encouraging to say that earnings could potentially turn around this year, especially off attractive valuations. And once the bar has been set low, they could really be good in terms of potential re-ratings happening in that scenario, as well as better economic growth prospects being, or at least from a cyclical perspective, occurring in China this year. And But one thing we are looking at very closely to, I think, give credibility to the story in terms of risk is taking a look at what is happening in credit markets. So as we've seen of late, credit markets have been quite jittery in China. And if you look at China high yield bonds, about 67% of that sector is made up of real estate. So I think we're all familiar with the real estate story that, really quite bankrupt real estate developers, not just Evergrande, but several of them in terms of defaulting, have really created a lot of risk in the market. So really what we would like to see from a prudent investment perspective is that the credit market yields start to retrace to more normalized levels. And just to give a comparison, just to give a better insight into that, you can see that yields are significantly higher from even compared to even lockdown restrictions. So what we would like to see is yields be a lot more calmer and to price in less risk going forward, which I think would give us a lot of confidence in terms of China having a cyclical turnaround. But what is starting to brew up in the US market, which is something not to be ignored, is that even though the US corporate high yield index is quite low from an interest rate perspective, it's starting to tick up the wrong way. So even when the Fed has not even ended quantitative easing yet, we're starting to see credit markets be a bit more jittery in terms of not exactly having that Fed put in place suppressing risk. And that is something that I think the Fed is going to be watching quite closely in terms of how quickly they need to tighten monetary policy. So they're at quite a difficult juncture where growth is almost certainly going to slow on a rate of change basis, and you're really having adverse financial contagion effects, particularly in the credit market in the US. So it will be very interesting to see how that plays out because inflation is quite historically high. So I don't think the Fed put, as we like to call it, is exactly there to really stabilize markets when inflation is really quite high and they need to fulfill their mandate of price stability. So going back to China, one thing that is very encouraging is we're starting to now see a turnaround in the Chinese credit impulse. And this is usually a leading indicator for economic growth and earnings potential in the Chinese economy. So we're starting to see less negative prints on a year-on-year basis, which would hopefully translate into better earning prospects as we progress throughout the year. One thing that I'd like to see is borrowing costs, proxied by taking a look at the interbank 3-month lending rate inflect lower. So really to have a lot cheaper cost of credit initiated in the market where that would really help, I think, stimulate a lot of further credit demand and translate into better consumption prospects and better earnings going forward. So that is something that we look at very closely to see is there evidence of that. And I think what is very encouraging is that the PBOC have really committed to easier monetary policy this year and to really support the broader economy, and that could be a potential opportunity in a further state if that story does really come to fruition. And that is something that we are watching quite closely, and that could be a potential opportunity on a regional perspective this year. What is also encouraging to see is the injection of liquidity. So another means of injecting liquidity is through the repos. So what we're starting to see through various facilities is that the People's Bank of China is really starting to inject liquidity on a daily basis, which could support broader financial market stability and really foster better economic growth prospects from here, and also give a lot more confidence back to the market that the PBOC really is trying to support the broader economy and not create adverse financial contagion effects. So that is very encouraging and something that we think will likely continue in the year ahead, and that could be a potential opportunity in terms of allocation from here. What we have seen from a flow perspective, if you take a look at the Institute for International Finance data, is that there really isn't appetite yet for the emerging market space in terms of equity and bond flows, and that is actually up to the end of January data. So that could actually spark a potential opportunity before you see significant flows in that regard, where a lot of the emerging market countries have already had, their hiking cycles in terms of monetary policy. They've already had a lot of the growth prospects, I think, not be as strong as what we had initially anticipated, and it could be a much better year in terms of emerging markets outperforming. And there has been potential selected opportunities in this regard. And it's really those countries that were laggards to the vaccination rollout and the sort of delayed reopening prospects. So we see some opportunity potentially in that space. And that's certainly been the case here today if you compare emerging markets relative to your developed market counterparts. So that is really where we're seeing the opportunity, and that is currently how we're positioned in terms of trying to realize that opportunity in 2022. So now on to market performance and sentiment checking. So if we take a very detailed look at what is happening to the US markets, the S&P on a more constituent level, you would see that the S&P is down nearly 6% year to date, right? The stark outperformers, I think, as we all know, has been energy on a year-to-date basis because of very tight levels of supply, as well as financials with a lot of the repricing of monetary policy expectations along the yield curve. So obviously being very beneficial in terms of the NIR that many banks would get from that. But what is more interesting is to actually look at the trend. So on a one-quarter basis, I just want to point your attention to the left-hand side, is to take a look at what has been happening to consumer staples and utilities, for example. So the more defensive type sectors have been relative outperformers compared to the broader index. And that is what we think will potentially be the opportunity in terms of really looking at companies with stable earnings that don't have high base effects like other more cyclical sectors to compare against. And from a risk reward perspective, that is, I think, where we feel a lot more comfortable allocating our capital for our clients to try to realize stable levels of returns in a slowing economic growth environment. But take nothing away from the extraordinary earnings seasons that we have seen all of last year. So what we have seen so far is still earnings surprises to the upside, which is very much encouraging. But perhaps what is more important, I think, is to really take a look at the guidance that is coming out of companies and to really look at, what is being priced into forward earnings, what base effects do they have to compare to as they progress throughout the year, because they had an extraordinary year in terms of growth rates. And really to keep up those earnings momentums, you need to have another extraordinary year. And again, arguably, that is going to be very, very difficult in a year where a lot of these catalysts have dissipated. Monetary policy, fiscal policy, now turning to a more tightening-like scenario. So we think that the risk-reward opportunity likely exists perhaps more outside the US and within the US on the defensive side, because we think it's going to be very, very difficult for a lot of these companies to have stable earnings, to give the level of earnings that they have last year, and to really realize a lot more upside from here. So to delve into some of the specifics on the China and emerging market front, you can see that over the last month, China's been a slight relative outperformer versus its emerging market in total return terms. But what we would like to see is a lot more of the cyclical sectors really take stark leadership. And that's exactly what we've seen. So energy, financials, real estate, all these sectors over the last month have done relatively well in terms of contributing to total returns. But it's still a little bit of a mixed bag where technology has been a relative underperformer, and your defensive sector like stables have been an outperformer still. So it's a bit of a mixed bag. So I think what we would like to see is concrete evidence in terms of more cyclical-led leadership and more defensive underperformance, particularly in the China region, to allocate capital with confidence heading from here. So that is something that we're going to look out for in terms of the coming weeks as well as months, to see if that it really does warrant capital allocation from here. But take nothing away, on a one-year basis, the China and emerging market story has really been quite poor. And for the reasons that I mentioned earlier, that there really were laggards in terms of the vaccination, there were laggards in terms of the reopening prospects, and those could potentially be some of the winners this year. And that is exactly what we think is likely to transpire. So I'll speak about that in terms of our positioning a bit later. Right now, what we're seeing, I think, in the global financial system is fragility. So some of the indicators that we watch quite closely in the cross-asset volatility space is we take a look at forward rate agreement overnight index swap spreads, and really what you're starting to see price in on the longer end of that curve is it's a lot more riskier where you started at the beginning of 2021. So, encompassing market risk, counterparty risk, liquidity risk, those sort of cracks are starting to show through the spread, albeit it's still very, very low levels, but very different place to where we started 2021. On the top right-hand side, we see option-adjusted spreads in the high-yield space are now starting to increase, which has been particularly bad for high-yield credit in terms of total return earnings, or total returns in the high-yield space. So option-adjusted spreads are increasing, and credit does usually lead equity market performance, and that is something that we're paying very close attention to in terms of are we going to see a further blowout from here, especially if we have disappointing economic growth prospects. Because if that does come to fruition, then the probability of default in this space is actually increased in this pricing, and that continues to rise from here. So that is something that we're going to look out for very, very closely, and rather stay away from a lot of the regions that had very good growth prospects last year and look towards more opportunities that, particularly in the emerging market space. So on the bottom left-hand side, you can see the VVIX to VIX ratio. So that's one of our indicators of risk in the market as a sort of fear gauge on the S&P, and VIX pricing and options. So usually when that ratio does retrace from its trading range, let's call it, it really does indicate that you may not necessarily be in a buyable dip scenario. And that is just another one of the many indicators that we watch to say, is this something that we are comfortable doing with, or do we expect, market participants to start scaling into VIX futures because they think the market is going to go down and that risk is underpriced? That is something that we pay very, very close attention to. And then lastly, if you take a look at global foreign exchange volatility on the bottom right-hand side, you can see that is starting to be priced in a lot higher in the options market. And really the key message here is that there is fragility in the global financial system, particularly in the US, where we think opportunities certainly lie outside that region. So now on to multi-asset performance and positioning. So to take a look at our performance over the last year, so encouragingly, we have, even at the end of January, in terms of the market sell-off, still managed to beat our peer group with higher levels of Sharpe ratios and higher levels of absolute levels of return. So Ashburton Investments is really about risk management and risk preservation. So if you compare ourselves to our peer group, in this scenario, our peer group has a starting point of 75% equities and 25% fixed income and one of our higher asset allocation ranges for global growth. Yet our upper equity limit is at 75% equities. So even with that in place to keep to certain risk parameters, we still manage to outperform our peer group on an absolute levels of return basis. But really, I think the message is here that we try to achieve that with lower levels of risk. So it's really about drawdown management relative to our peer group and for our clients. And then if you take a look at our balanced fund range, a very similar story, where last year we managed to outperform our peer group and have high Sharpe ratios with containing levels of drawdown to really get suitable levels of returns with reasonable levels of risk for our client base. So higher risk-adjusted returns is really what we try to achieve from an Ashburton investment perspective. And that's really at the epicenter of our investment philosophy, really to generate absolute levels of returns using our top-down framework, which is also complemented with our bottom-up valuation framework, where the two come together to help us realize the opportunity in the global financial world. So to end off on positioning, so at this juncture, across the multi-asset fund range, we still maintain our overweight equity bias, but it is very much selective on those regions, like I mentioned earlier, that have delayed opening prospects. So we also underweight the developed equity region. We think that risk reward in a potential slowing growth dynamic, especially with quite a hawkish monetary policy outlook for the US Federal Reserve, it does not necessarily warrant as much capital relative to other opportunities that are out there. So that is also why we are overweight the emerging market space, where there are selected opportunities out there. So in spaces like Indonesia, for example, where they have very good growth rates, they surprise upwardly from a GDP perspective, and even broadly in the ASEAN region, where you look at regions like Philippines, Singapore, Thailand, where they have very good, strong growth projections, as well as very bright reopening prospects if we do see a normalization in economic activity, as well as the easing of lockdown restrictions on a global level. I think these would be quite significant beneficiaries in that regard, and those are a lot of the regions that really have deserved our capital allocation on a year-to-date basis. And thankfully, a lot of these economies have realized total returns of anywhere from 3 to 6% on a year-to-date basis. So that is a very stark comparison to what we're seeing in the developed equity space. From a fixed income perspective, we are underweight still at this moment in time, but we still see opportunity. So we are overweight China government bonds, and one of the main reasons for that is for rate stability at this juncture. So that has still been positive in total return terms on a year to date. basis, and it really is because they're on a different cycle. So monetary policy is easing, growth is still somewhat muted, so yields haven't really popped significantly just yet, and that really does help create diversification in terms of capital allocation in the fixed income space. So we see that as an opportunity, and also the fact that we've got an easier monetary policy backdrop to support, I think, more stability in terms of yields. Now, in the real estate and gold space, we are overweight. From a benchmark perspective, we are neutral on real estate. It does offer a relatively good inflation hedge, but we have to acknowledge that it is still very interest rate sensitive. So we do have a very neutral view in terms of the countervailing forces there. But what has worked out in terms of a recent allocation for us is gold. So gold, not necessarily as an inflation hedge, because that certainly wasn't the case last year. It's more of a growth hedge. So gold does backtest relatively well in a slowing growth economic environment, and that is exactly what we think we are likely to realize this year. So as a growth hedge in terms of many uncertainty, many things that are very uncertain at this juncture in terms of monetary policy, in terms of growth outlook, it really offers a very good blend in terms of diversification across our multi-asset fund range. And then in our cash allocation, we have obviously utilized some of that to really deploy cash to the ASEAN countries that I spoke of earlier, as well as gold, to really realize something in terms of, a store of value. I really hope that was somewhat insightful today. I appreciate all of you attending today, and I'm happy to take any questions in the chat, or if my colleague Adam has addressed them, I really appreciate that. So I will take a look at any of the questions if there are any, but please, again, feel free to ask any questions that you may have, or reach out to me via email as well.
There are indeed a few questions in the chat. Jarred, do you want me to read them out to you and you can respond if you want?
Yes, please. I can't see them.
No problem at all. So they all seem to be around the very topical topic of monetary policy and yields, unsurprisingly. So the first one is, what, if any, factors do you think will need to be present or hold for US Treasury yields to retreat from their current levels, which obviously, I think as of this morning, just over 2%. Do you expect 2 consecutive negative return years for US Treasuries, or do you expect them to reverse their losses year to date by the end of this year?
That's a very tough and a very useful question. So no, I don't think yields can go significantly higher from here. And even if they do, we also got to realize the coupon that you get semi-annually from a lot of these treasuries. So if you do stick it out and yields even stay flat from here, that does offer better than your cash rates at this juncture. And it's really a question of, have we hit peak hawkish rhetoric from the Federal Reserve? Because if they really do hike 6, 7, 8 times into a slowdown, as I showed earlier, that has drastic ramifications for yields. The yield curve can collapse and they can reverse policy course from there. But it is a tough one because, as we know, inflation is still quite high. So I think that as a shock absorber in terms of the risk, fixed income allocation will certainly have its pace in terms of allocation in a multi-asset fund range. So I don't think that we can see significantly higher yields from here. And it really is a story of the longer term outlook. So one is you have lower population growth, which is really the fundamental underpin of what is going to foster growth prospects in the future state. And funny enough, if you take a look at last year's US population growth, it was 0.1%. It was the lowest on record. So that is really speaking to the fact that that's why we have low labor force participation growth, lower potential growth rates in the future, and that could suppress yields in terms of limit the upward bias that we could potentially see in a future state. So that is one of the fundamental underpins, as well as the level of being able to service your debt. So as we all know, the US government debt is exorbitant, and really to monetize the fiscal deficit, if you will, you really need contained levels of yields in that scenario. Otherwise, you're going to have to roll your debt to unsustainable levels. So for these reasons, I think that yields will certainly have, I think fixed income allocation certainly does have its place, and I don't think that the Fed can be more hawkish than what they are. And if we are at peak hawkishness, then I think fixed income allocation is a suitable diversifier and a good shock absorber and an exogenous event, especially if we see downside surprises to economic growth.
Perfect. So the next question is actually on fiscal policy. So this one is, I have seen or heard that US fiscal spending year on year should decline, or sorry, the decline will be considerable in the second quarter of this year. Do you have a feel for the extent to which this could or will be a drag on US Q2 GDP?
That's a very good question. So yes, fiscal drag is going to be immense this year. So if you looked at a lot of the fiscal stimulus packages that they were speaking about a couple of months ago, they were speaking numbers of about, $3 trillion, then it was $2 trillion, now it's about $1.8 trillion. And even then, Manchin did not want to pass, heavy fiscal stimulus because of the impact on inflation. So that's also another conundrum. That's also another issue. So I think it will be a very real material drag on growth this year, that you don't have that fiscal support like you did last year. You don't have that unprecedented policy. So I think that is going to significantly weigh on growth prospects. And I think that's exactly why you're seeing economic growth be downwardly revised. And in fact, if you look at the monthly numbers, if I'm not mistaken, there was a budget surplus in January for the US numbers. So yes, it is going to be a material headwind for growth, a very big one, in a tightening liquidity environment and in an environment where labor is still, I think, 3 to 4 million jobs off pre-pandemic levels. So on a rate of change basis, even real incomes are nowhere near where they were in 2021 with the 3 rounds of stimulus checks that we saw. So all these things, I think, are going to be material headwinds to the US economy. Is that
brilliant? So the next, there's just a couple more in there. The next one goes back to monetary policy. So it is, hi Jarred, it seems that the Fed and a lot of analysts and PMs got the call wrong on inflation and how long it would last. How did they get it so wrong?
I think that's that's also another very good question. So I think that because there's a recency bias. So if you actually rewind to the last 10 years, inflation was never really an issue, right? If you had mild overshoots of 2% and the sort of structure of the inflation basket was never really geared to have this sort of inflation. So I think people really underestimated the supply side shock that lockdown restrictions would have to trade, and really suppressing a lot of the supply on the global front led to tight supply and pent up levels of demand, and that really helped thrust upward levels of inflation. And I think what was really missed in the context of what happened in 2020 especially is that very low levels of interest rates really thrusted upward impetus to housing prices, which, as I mentioned earlier, that shelter price component is a third of the inflation basket weight. So I think that was really missed in terms of the inflation trajectory. And I think in terms of our core inflation, I think we suitably played that because our biggest allocation from an investment perspective was allocating to US energy companies. Very good free cash flow yields, very good, obviously, tight levels of supply into a very strong economic growth environment. It was something that we thankfully saw and we took advantage of, and obviously being significantly underweight bonds and high yield credit at that time. So I think it really does pay to really try and be ahead of the curve and to look at what the ramifications of policy will have in the next 6 to 12 months, rather than relying on what the status quo has been.
Brilliant. So there's just 2 more, so we should get them in just in time. So the second to last, is it not possible that the labour force participation rate is low because of the stimulus checks people received, obviously, over the last couple of years? And would this not put more upward pressure on inflation via wages to get people back to work?
So that's also a very good question. So that's why I mentioned population pyramids, the fact that it really is a demographical problem, because if you look at the labor force participation rate over the last 2 decades, it's been on a clear downward trend. But to your point, yes, a lot of the stimulus checks I think have kept a lot of participants outside the labor force, and I think the labor markets certainly do have a lot of bargaining power in terms of wages from here. So I think we'll see higher nominal wages from here, but that's not always great from an earnings perspective. It eats at corporate margins, and I think that is something also to consider in this context in terms of is this going to really hurt company earnings if they do have to pay higher wages, or will it be some sort of evidence or mechanization element of that? Because obviously with technological advancements, I think that you will see some sort of substitution effect of that take place. So to your point, yes, the labor force participation rate can potentially rise from that, but population pyramids are certainly not favorable for sustainable rise in that, at least in the near future. And also, one thing I haven't mentioned is that there were a lot of early retirees. So if you look at the S&P market, I stand to be corrected, but it was up about 125% over the last 3 years. So a lot of those participants are not coming back to the labor force. There's a lot of capital that is now sufficient for retirement purposes, and it is going to be a real struggle, even after accounting for immigration, in terms of really trying to acquire labor back into the market. So I think that is going to be still a struggle from here.
Great, and then the last one, I think you've already touched on this. So with US debt at $30 trillion, what are the implications? Also, why is this not very topical?
So it's not very topical because of the low levels of interest rates. So it's rather focused on debt servicing ability, which is still relatively affordable, even though the absolute level of debt is still quite high. So because debt servicing costs have been very, very low, and that's actually one of the fundamental underpins as to why I don't think yields can be sustainably go, to 3, 4, 5, 6% from here, is because your debt servicing ability from a government perspective will be out of control in the absence of policy reform, where you would need even more material fiscal drag to keep levels of debt under control. So it's really nothing being well spoken about enough because of the debt servicing cost being, at near record low levels. So I think that's one of the main reasons for that. But take nothing away. There's been arguments about lifting the debt ceiling, and the US has never defaulted on their debt in history. So I don't think that will be an issue. It's just I think there's now being a lot more pushback in terms of we can't continue on this path. Otherwise, you're really going to impede foreign direct investment and the credibility of such in terms of your policy backdrop. So I think just to answer your question, I think just because debt servicing costs have been very low and they can roll their debt, and I think they have the advantage of also being one of the main reserve currencies around the world, accounting I think for about 60% in sovereign drawing rights for around the world.
Brilliant, and that is the last question.
Cool. Well, thank you everyone for your time. I hope it did provide some sort of insight into our thinking. We really appreciate your attendance in this regard, and I think that's on cue to exit here with the lights turning off in the room as well. But thank you very much again, and have a great afternoon, everyone. And please feel free to reach out if you have any further questions. Thank you.